And the last example that I want to show you here is a case where the risk exceeds our percentage risk completely. In this case, 100,000 times 2%, that's obviously 2,000. Now we're dividing that by 3,000 because that's the volatility in that market. Well, that trade's got too much risk. That ends up equaling 0 contracts. So in a case, let's say there was a full-size S&P contract. I keep using that example with the S&P because it is a big moving contract. And let's assume the risk in it was $3,000 or $4,000 or $5,000, and you only had $100,000 in your account. That's a market that you just simply shouldn't trade at all, period. That you should just simply reject those trades. And with the proper position sizing based backtesting software, that's exactly what it'll do for you, is it will skip those trades in the situation where your account equity is not great enough in order to trade that market. Okay, moving right along here, I want to move on to sector risk and how we should manage and control our sector risk. And the point that needs to be made here is that many markets are very highly correlated. If you let's look at the stock market, for example. People a lot of times will trade a whole lot of different stocks and think they're diversified, but the fact of the matter is that if the market as a whole comes crashing down, generally speaking, all the stocks come crashing down too. And diversification really didn't mean a whole lot because in most cases many of those stocks were highly correlated. And it's the same in futures. You've got sectors in the futures market that tend to be very correlated. I'll use the example of the energies. In the energies, you've got things such as crude oil, heating oil, unleaded gasoline, and they're very highly correlated. When one goes up, the other ones tend to go up. When one goes down, the other ones tend to go down. So, and if you're trading all three of those markets in this example at the same time, you're really not diversified between three different markets. Really what you've done is you're in the same market times 3. And that can equate to too much risk in a given sector. And we need a way to manage that risk per sector so that we don't get lopsided, so that we don't get overweighted in one area. This is, if you can imagine a wheel, we want each part of the wheel to be equally weighted so that it doesn't get out of sync or out of whack, so that we can roll along smoothly. We need a way to divide the markets into sectors, and that's something that most backtesting, well, I shouldn't say most, the few backtesting software packages that can do position sizing will allow you to do, is to take the markets that are correlated and assign them a sector. For example, grains, or energies, or financials, or metals, or meats, etc. And once they are divided into sectors, what you can do then is to sum up the risk in your open trades in a given sector. So that, let's say that, we look at the energies again, and we realize that we're in crude oil and we're in unleaded gasoline, and we sum the risk of those up, and the risk in that is, let's say, 5% between the two, and then we get a new trade signal to get into heating oil. Well, in my case, I'd want to reject that heating oil trade, because I like to make sure that the risk per sector does not exceed about 5%. And let's just look at an example to make this a little bit clearer graphically. Again, you've got, let's say, a heating oil trade, and if I did these in reverse order, I apologize, but you've got graphically here to keep it straight. So let's assume we've got a heating oil trade, and the risk in that is 2.5% to your account, and that's currently an open trade. And you've also got on a gasoline trade at the same time, and that risk to your account is also 2.5%. So now your sum total risk in the energy sector is 5%, and this is the maximum. You don't want to exceed that amount. And all of a sudden, a trade in crude oil comes up, and that trade, if put on, would cause you to exceed your maximum sector risk of 5%. What do? You just simply reject the trade and don't take it. And this applies to each sector, and it's what the smart money does. It's what you should be doing. It's a way to keep yourself out of trouble and not get overly weighted or overly lopsided or dependent, I should say, in one given sector. Along these lines is another similar or related concept, which is called total risk. And in the industry, there's a buzz term or a buzzword for it. Sometimes it's referred to as portfolio heat. And it's a very related concept. And what it means, well, let me first back up and say that when you're trading a whole lot of markets, it can be possible to overtrade. You know, if you've got 60 or 70 or 80 futures markets that you're trading, and you keep getting signal after signal after signal, you can get to the point that you've just got too many trades on in the account. And there needs to be a way to control that total exposure at any given time. And again, we're going to look at this graphically, but just for the sake of example here, I like to keep my total risk underneath about 10%. Occasionally I exceed that amount when the markets are running in our favor, but you know, in the case of my relativity trading system, I've got it set to about 10% of a maximum. So again, let's look at a graphic example here. Let's say you've got on some financial trades and that risk in that sector is about 2%. You've got some grains on, maybe, you know, whatever, corn and wheat. So you've got 2% risk in grains, some metals, and some energies. And by the time you add all these up, you look at the risk of every single market that you're in, let's say it's now up to about 10%. You can see there you've got 3 and 2 and 2 and 3, a total of 10% of risk. Now, let's say a new trade comes up in the meats, pork bellies or live cattle, something like that. Just like we rejected the trade because it had too much risk in a given sector, you also, in this case, I would recommend that you reject the trade because you've got too much risk in the total account, your total portfolio risk, or your total portfolio heat. And by doing that, it can really help to keep you out of trouble big time. You don't want to get into a scenario where you've just loaded up the account with trade after trade after trade, and you know, should there be a scenario where each and every single trade you're in gets stopped out of simultaneously, you know, you lose a tremendous amount of money. The idea with keeping your portfolio risk in line is that should that happen, you know, let's go back to the 10% example, should every single trade you're in get stopped out at a loss simultaneously, that should not exceed about 10% of your account. And it can really make nights a whole lot easier to go to sleep. Let me put it that way. In summary, let's look at the point here that we went over. We talked about the fact that we need to normalize the risk per market, that all markets are not created equal. You've got some contracts that move around thousands a day and some contracts that move around hundreds a day, hundreds of dollars per day, and you need a way to normalize that so that each market is treated as an equal. And once we do that, once we determine the proper number of contracts to trade, we can, you know, then everything is normalized and equalized. At that point, we want to make sure to risk no more than about 0.5%, maybe up to a maximum of about 3% of the equity per trade. And again, for the sake of keeping this presentation short, that's all I'm going to say about it. I mean, I could go through countless examples and we could talk for hours about different amounts to risk, but I'm just telling you from experience that if you're looking to trade relatively conservatively, which I do, those are the ranges that you should keep your trading in. Along those lines, you want to limit your sector risk. You don't want to get overly weighted in, you know, grains or energies or any given sector. You want to keep it very, very normalized and very equalized between the given sectors. So limit your risk per sector to about 5%. And then as far as your total risk or your total portfolio heat, I recommend that you keep that under about 10%. And all of these are things that you can do with the right backtesting platform. There's only two that I'm aware of that do this properly. And one of them is a product called Trading Blocks, and another one is a software platform called Mechanica. And both of them are highly recommended. I'm just, in my case, biased towards Mechanica. I was one of the original users of it back in the early 90s. I'm very familiar with it, and I just feel that it is the superior product in the marketplace for doing your development, for being able to plug in these kind of rules. You know, if you look at some of the other products available on the market for doing backtesting, they just simply don't do this. They don't do the position sizing, they don't do the sector risk control, they don't do the total risk control, and without those, in my opinion, you don't have a system. Anybody marketing a trading methodology that isn't simultaneously talking about how to normalize the markets, how to limit your risk per trade to a certain percentage, how to limit sector risk, how to limit total risk. If they're not doing all of those things, then they're not doing what the pros do, and in my opinion, or what I do, and in my opinion, it's something that potentially could lead to problems. So anyways, once again, I hope I didn't dump too much information on you too quickly here, but that's an overview of the way that I view position sizing, and I hope you found this useful and informative, and I look forward to seeing you, or talking to you, I should say, in video number 3, which is going to be on maintaining the proper mindset and trading psychology. So until then, have a profitable day. Thank you very much.